Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and today we are going to be looking at a new topic. The topic is called equity market equilibrium. Equity market equilibrium. Yeah. Specifically, what we'll be looking at, we'll be looking at the following. Number one, we'll look at the justification, just a brief explanation about the justification for the short term and long term equilibrium. Yeah, just a brief description about that. Of course, this concept has already been covered under economics. I believe once you've reached this level, you must have done economics at some level. Then we will move on and look at the Greenwald-Kroner model. Greenwald-Kroner model. There. This model is useful in trying to estimate the required return within the market, and what we will be able to look at, we will be looking at the formula of how to compute the Greenwald, the required return under the Greenwald-Kroner model. We will be able to specifically look at the inputs there. Then once we look at the Greenwald-Kroner model, we will be able to move on and look at the Cobb-Douglas we're saying economic function, economic function there. Then we will move ahead and look at the macroeconomic forecasts, and we will specifically look at the H model. We will be able to build on the H model. We had looked at it under the dividend discount model, H model there. Then we move on, building on the topic, we will be able to now look at something as the relative equity market or relative measures of the equity market equilibrium. So we say relative equity market valuation, equity market valuation there. Then we will now specifically look at the following. We will first of all look at the Fed model there. Then we move ahead and look at the Yardney model. I'm trying to look at the equity market valuation. Then we move ahead and look at the 10-year moving price, 10-year moving average price there. Now, once we look at these three relative equity market valuation approaches, we will be able to move ahead and look at now asset-based approaches to equity market valuation, equity market valuation there. And specifically, we will be looking at the Tobin's Q. Tobin's Q there. Now, this is what we are expected to cover so that we can be able to go and understand the equity market equilibrium under equity markets or equity investment analysis. So we start off by looking at the justification for the short term and long term equilibrium. So what we expected to understand over here, we expected just to understand the traditional curve over here where you have the price of a commodity. In this case, you're looking at the price of the market here and the quantity produced there. And we are saying we will be able to have an equilibrium price right at this part over here like that. And that is what we're saying based on these curves over here. Sorry, we're saying this is the demand curve there, and this is the supply curve there. So it is expected that this is the equilibrium price that will be accepted by both producers or producers and consumers at which they can be able to buy the product or they can be able to supply into the market. So we are saying the justification in the short run is that an increase or a decrease in the demand will cause some kind of effect that is going to be significant to try and change the equity market equilibrium, say for example to the new equilibrium value over there like that. So we can put it in writing and say something that in the short run, an increase, decrease in demand for assets, securities in the market will cause prices and output to increase, into brackets, decrease, like that. That is in the short run. As well, we can say in the short run, in the long run, apologies, long run, an increase, brackets, decrease in demand for assets, to brackets, securities, will have the same effect in the market like that, will cause prices to increase, decrease, but after some time to be influenced by macroeconomic factors. So such as, I can be able to put it such as the GDP, inflation, interest rates, amongst others. I can put ETC there, pardon me, ETC, and prices will tend to stabilize in the long run. Stabilize in the long run, stabilize to the long run average prices in to stabilize to the long run average prices. There. That is what we just need to understand under the justification for the short term and long-term equity market equilibrium or equilibrium prices. We know very well that the fundamental analysis in terms of looking at the DDM, discounted dividend model, the free cash flow valuation, we also mentioned about residual income, and finally market based valuation, price and enterprise value multiples, all represent fundamental analysis. This is there. So market based valuation there. And this has a tendency, or these decisions based that have been arrived at under the DDM, the free cash flow, residual income, and market-based valuation, will be able to be guided, or will be able to guide an analyst when they're looking at the long run. We are saying under technical analysis, this is an analysis that technicians use to try and make some inferences when buying securities in the short run there. So this is using the graphs, charts, and also market indicators, as well as mathematical indicators to try and predict market movements in the short run there. So it is an important concept that we need to understand, that in the short run, the increase and decreases in demand for assets in the market will cause prices and output to also decrease. As well, for the long run, will have a mirror effect as over here, but it will tend to stabilize to the long run average prices there. Remember one thing: marginal revenue should be equals to marginal cost. So that important concept would mean that if the cost of offering securities in the market should be able to be at least as much as, rather, the revenue that is to be earned in the securities market should be almost as equal, or should be able to compensate for the cost of entering the market at any given point in time. So that concept is very important in economics as well as in equity investment analysis. Now, having looked at the justification for the short-term and long-run equilibrium right over here, now we move on and look at the Greenwald-Kroner model that is used to estimate the required return within the market there. So the Greenwald-Kroner model, we say it is a model that is used in the securities market, the securities market. You can see the securities market. To compute the required return forecasted return, which is what you're saying is the forecasted return there. The formula is simple. We have R is given as D over P, which you're saying that is the dividend yield, D over P plus inflation. Then we add the growth, long-term growth rate component there, which will be given in the question there. And then we minus the supply, the S, or change in supply of the asset, change in supply. Then we add the component of the change in price to earnings ratio there, where R is required return there. D over P, we're saying, is the dividend yield there. I is the inflation component, or changes in the purchasing power of goods and services, inflation. Then G is the growth rate, long-term growth rate. Like that. Once we have the growth rate there, we also have changes in supply of the asset. Change in S is change in supply of the asset, or security in this case, like that. Then we have finally the change in PE. Change in P stroke E is change in the price to earnings, change in price to earnings ratio. There. That is, in simple terms, the Greenwald-Kroner model, where we try and predict or we try and factor in the inflation, the growth rate in the long-term growth rate, the changes in supply of the asset, and also the change in the price to earnings ratio. Remember, we had looked in market-based valuation. We had mentioned the PE as the market price per share divided by the earnings per share. That's how we compute the PE ratio there. Now, we move on and look at the Cobb-Douglas economic function. Why these models are useful under equity market equilibrium is because when trying to predict the point where we have the supply of securities or the asset versus the demand, we need to understand these estimates or the estimates of required returns so that we can correctly predict the equilibrium price of the asset or the security there. Now we move on and look at the Cobb-Douglas economic function. Cobb-Douglas economic function. Cobb-Douglas. Cobb-Douglas, we're seeing economic function. There. Now, what we need to do is that we just need to know how the formula looks like in trying to estimate the economic output of securities or the general economic output, which is based on total factor productivity and labor inputs there. So we write the equation over here and say that the Cobb-Douglas economic function, before we write the equation, we mention something brief about the Cobb-Douglas economic function. This function is used to estimate the output which are factors, which includes factors of production, which includes factors of production, including, we can say, the total factor productivity, there, which also includes the amount of labor, the cost, the amount of labor. Just pause. Cut. 3, 2, 1, action. So we are saying, once we look at the total factor productivity, the labor, we also look at the capital stock. There. So the how to measure real economic output, we can't be able to write the equation. The equation is given as follows, where we have y is given as AK. I'll be able to explain all of those inputs over there. Then we have power alpha. Then, of course, this is multiplication there. And then we have the value of L, the labor component, which is given by beta here. Now, this A, the Y, rather we start with Y, is real output there. Then A, we can say that A is the total factor productivity. Total factor productivity there. And then K, we are saying, is the capital stock. And then we say that L is the labor output. This alpha represents a constant there. So this is a constant, and also that is a constant. These are constants, and also beta is also constant, like that. So those are constants there that relate. This is a constant. Alpha is a constant that relates to capital stock. Then beta is a constant that relates to labor there. So you should be given something that is very specific. Or this constant relates to the capital stock, and the other one relates to the labor productivity. Now, building on this Cobb-Douglas equation, we will assume that that we will be able to now get the change in y, or we put natural logarithms on this, so that we can be able to try and remodel this Cobb-Douglas equation to become something that analysts can be able to use in the financial services industry to try and predict output, the real output there. So he's saying applying natural logs, we apply natural logs and we divide each component. So we have change in y over y there, which is given as change in a over a there. Remember, we are applying natural logs, so this one comes down there. So we'll have plus alpha change in k over k, plus we will be able to now be given this constant over here. Now this constant can be expressed in terms of the alpha there. So we're saying where beta can be equal to 1 minus alpha, like that. So that is a very critical assumption that we need to make in the Cobb-Douglas equation. So we are saying that now bringing this component down, we are saying 1 minus alpha. We've already explained that beta will be 1 minus alpha there. And then we multiply by change in labor over the labor output component there. So this is what we're saying is the remodeled Cobb-Douglas equation there. What we can do is that summary, we can be able to say that the Cobb-Douglas equation is given as change in y is equals to change in a plus alpha change in k over k, rather not over k, change in k plus 1 minus alpha change in L, right there. So that is how we are saying it should be the Cobb-Douglas equation. So we try to look at an example that can be able to apply this concept of the Cobb-Douglas equation. The example reads as follows. When performing an analysis of 3 economies, an analyst compiled the growth and elasticity data in the following table. So we have country A, B, C, the percentage growth in total factor productivity 1, 2, and 3, the percentage growth in capital stock, that is the K component, is 2, 2.5, and 8. We have the growth in labor input 1, 4.5, and 2.5. Output elasticity of capital. That output elasticity of capital we are saying is the component of alpha. We have 0.5, 0.3, and 0.7. Required for each economy, determine the expected 10-year average annual GDP growth rate there. And number 2, comment on the 3 economies there. So when you're told to compute the expected or the forecasted GDP growth rate there, then we will be able to apply the Cobb-Douglas equation. Over here we say solution. There we say based on the inputs, we are trying to estimate change in y. So the change in y in the first case, we can have a summary here. Scenario 1, like that. So we say change in y is given as, now we have the A component. We said A is the total factor productivity over there. So we have 1, which has been given to us. You can be able to see correspondingly there country A there. So we're working with country A there. So we have 1 plus we say we've already been given the output elasticity as 0.5, so we need to put 0.5 as that alpha component multiplied by the cost, the capital stock, the capital stock which we've been given as 2 there. Then plus, now we have 1 minus alpha they are given to us. So 1 minus 0.5, which you're saying is 0.5, and then we multiply by the labor component there. The labor component which you've been given there is 1. So that is the first case. That in the second case, we can be able to first of all combine them, then we'll be able to work them out. Change in y, in the second case, we have 2 given to us plus 0.5 multiplied rather, is it 0.5? I can see it's 0.3, pardon me, 0.3. 0.3, which you're saying is the component of alpha multiplied by 2.5 plus, now we have 0.7, 1 minus 0.3, which you're saying is 0.7 multiplied by how much? You can see 4.5 there. How much do we get? Then number 3, we have change in y given as, we've been given the A component, which you're saying is total factor productivity, as 3 plus, I can see 0.7 multiplied by 8 is what you're saying is the growth in capital stock there, plus 1 minus 0.7 there times, we're saying we have how much? 2.5. 2.5. How much do we get in the 3 cases? Very quickly, we compute. So we first of all work in brackets over here like that. So we have 0.5 times 2, of course, that is 1. So we have here 1 plus 1 plus 0.5 multiplied by 1, which you're saying is 0.5. 0.5. So here we have 2.5. And of course, it's percentage. Yes, so that's 2.5% in the first case there. In the second case, we have 0.3 multiplied by 2.5. We have 0.75. So it's 2 plus 0.75 plus we have 0.7 multiplied by 4.5. We have 3.15. So how much do we get? 3.15 plus 0.75 plus 2. We have 5.9%. So these are the figures that we will be trying to evaluate based on the economies, the nature of the economies, based on these inputs: the capital stock, total factor productivity, and the labor output. And we'll be able to make a decision in part 2. Now here we have 0.7 multiplied by 8. We have 5.6. So it's 3 plus 5.6 plus we have 0.3 multiplied by 2.5. We have 0.75. How much do we get? We add 5.6 plus 3. We have 9.35%. 9.35%. So those outputs or those growth rates are the ones which we'll be able to try and describe under part 2. So that is part 1. We've been able to compute the output there. Part 2 is asking comment on the 3 economies. So we're saying that economy A would appear to be a market close to equilibrium. Why? We are saying because the expected annual rate of growth is only going to be about 1%. We've already been given that 1% right over here. So we are saying that is large developed economy. So that is what an analyst should be able to infer based on the input given there. So you're seeing the total factor productivity as being 1%. You can see the growth in capital stock is almost close to the total factor productivity of 1 as well. We're seeing the growth rate in labor is growing at 1%. We're saying that this one in conclusion would be a large developed economy there, which is close to equilibrium there. In the second case, we are seeing that the workforce growth rate is at 4.5%. That is the growth rate in the labor input given to us there. However, we can see that has an impressive workforce which contributes towards the economy. They significantly contribute towards the economic development, and hence we are saying that this could be a relatively small economy such as Kenya's, where you're seeing a lot of the labor contributes towards economic growth there. You can see even the 5.9% is almost close to what we are seeing our economy is actually growing by, about 5-6% there. Or 6.5% is almost close to this one here. So we're saying that that is a relatively small economy that is driven by workforce. In the third case over here, we're saying the capital stock is expected to increase significantly over the next 10 years, because we're basing our estimates here on 10 years. And we're also saying that the increased economic output, why we are saying the increased economic output is of this component of 0.7. The economic output over here would mean that the economy is larger and more developed, and it is growing at a very fast rate. We are saying the economies such as of Malaysia and Indonesia could be at this level. Over here we are saying is moving at 9.35% there. That is what we can be able to infer based on those computations right there. Now, having looked at the Cobb-Douglas economic function, we can be able to conclude around that point, and we will be able to continue in our next lesson by looking at the macroeconomic forecasts based on the H model and looking at the relative equity market valuation model, where we look at the Fed model, which is used in the US, the Yardeni model, and also the 10-year moving average price. We will be able to conclude our next lesson by looking at the asset-based approaches to equity market equilibrium, where we will be able to look at the Tobin's Q. Thank you for joining me. We hope that you'll be able to join us in our next lesson.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.